Welcome to Market Phases, the hidden blueprint behind every price move. In this video, we'll uncover how the market moves through 4 key phases, a pattern that repeats across all timeframes. Understanding market phases is the foundation of reading price with context and confidence. Once you learn this, every chart will start to make more sense. Let's begin the journey through the market cycle. There are 4 repeating market phases: accumulation, markup, distribution, and markdown. These happen in all markets, all timeframes. Each phase represents a battle between buyers and sellers. They are driven by psychology, liquidity, and smart money behavior. Learning these phases helps you trade with the trend, not against it. So let's dive in and explore each phase in detail. Accumulation is the phase where smart money quietly builds their positions. Price often moves sideways in a tight range with low volatility, appearing calm on the surface. Many retail traders think nothing is happening here, but this is frequently where major moves begin. Volume is usually low during accumulation, so watch closely for subtle shifts that signal smart money activity. The markup phase begins when price breaks out of accumulation and starts trending upward. Strong buying pressure enters the market, and momentum picks up quickly. This is when retail traders start jumping in, often after the move has already begun. Volume typically surges as price accelerates away from the range. Distribution is the phase where smart money begins offloading their positions. Price often moves sideways again, forming a top while momentum starts to weaken. As you can see on the screen, fake outs become common, designed to trap late buyers. Retail traders frequently mistake this for just a pullback and get caught on the wrong side. This phase is a clear signal that the uptrend may be coming to an end. Markdown is the downtrend that follows distribution. Sellers take control, and the market begins forming lower highs and lower lows. As shown here, volume often spikes during breakdowns, signaling strong bearish momentum. Emotions run high in this phase. Retail traders panic sell, often near the bottom. Markdown continues until smart money steps back in and accumulation quietly begins again. After the markdown phase, the market returns to accumulation, starting the cycle again. These 4 phases repeat over and over, in every market and on every timeframe. You might see them on a 15-minute chart or on a monthly chart. The pattern stays the same. The image on screen shows this full cycle clearly. Now, let's look at each phase in more detail, with real market examples. Now let's take a closer look at the psychology behind the accumulation phase. This is when fear dominates the market, and most retail traders are too hesitant to buy. Meanwhile, smart money is patient, quietly building positions while price moves sideways. As shown in the image, the range often creates fake outs in both directions, shaking out weak hands. Most traders overlook this phase, or even short it, but this is often the ideal time to prepare for long trades. Along with psychology, the structure of accumulation also tells a clear story. Look for equal highs and lows, fake outs, and liquidity sweeps inside a tight range. As you can see in the image, this sideways movement often forms a base, a zone of quiet accumulation. Wicks outside the range are common, used to grab liquidity before the real move begins. A clean break of structure is what usually signals the shift into the markup phase. Now let's look at how volume behaves during accumulation. Most of the time, volume stays low while price ranges quietly. But when you see a sudden spike, especially during a fakeout or breakout, it's often smart money testing liquidity. As shown on the screen, a breakout backed by strong volume usually confirms a real move. If volume is missing, it's more likely to be a fakeout. Once accumulation ends and the breakout begins, we enter the markup phase, and psychology shifts fast. Retail traders start chasing price as it trends upward. Fear turns into greed, and pullbacks are seen as discount buying opportunities. FOMO kicks in with every new high. But as shown in this stage, smart traders already positioned themselves during accumulation, long before the crowd joined in. Now let's break down the structure that defines this phase of the trend. We begin to see higher highs and higher lows, which confirm that the market is moving with bullish intent. Each pullback finds support at previous resistance, showing that buyers are stepping in to defend those levels. Break of structure and change of character signal that momentum is continuing, not fading. But be mindful, if price breaks below key structural points, that's a sign of invalidation, and the trend may be weakening. After structure, volume adds another layer of confirmation during the markup phase. You'll often see volume rise during breakouts and strong impulsive moves. Pullbacks, on the other hand, tend to have lower volume, showing they're just pauses, not reversals. Strong volume confirms bullish conviction, while a sudden drop can hint at fading momentum. And if you spot divergence between price and volume, that's a sign to be cautious. As the markup phase matures, psychology shifts again, this time into distribution. Retail traders are euphoric. Everyone's bullish. Meanwhile, smart money begins quietly exiting their positions. Price starts to move sideways near the top, forming a range. Retail keeps buying the dips, not realizing they're walking into a trap. At this stage, fear hasn't returned yet, but the signs are starting to build. Following the shift in psychology, the structure of distribution reveals what's really happening behind the scenes. You'll often see double tops, lower highs, and failed breakouts. Equal highs act as liquidity targets, engineered to trap late buyers. Early in the range, CHOCH may appear, hinting at a shift. The structure often looks messy, and that's intentional. A clean break of support is what typically confirms the start of markdown. During the markup phase, volume was healthy and supported the uptrend. But as price entered a sideways distribution range, volume began to decrease, a sign of weakening momentum. Occasional fake outs and wick-heavy candles within the range showed temporary volume spikes, revealing hidden selling pressure. Once the markdown began, volume increased noticeably, confirming that strong hands had finished distributing and the sell-off was underway. As distribution ends, the tone shifts, and markdown begins. Panic returns, and retail traders are stuck holding losing longs. Many believe it's just a correction, but smart money is already short or completely out. As you can see in this phase, price breaks down aggressively. Fear takes over, and emotions start driving decisions. Let's break down the structure of the markdown phase. Lower highs and lower lows take control, confirming the downtrend. Previous support levels often fail on retests, showing clear weakness. Trend lines now slope downward, and you'll often see descending channels or bearish price structures, like the one shown here. Patience is key. Wait for a clear shift before trying to call a bottom. In the markdown phase, price continues to form lower highs and lower lows, confirming the downtrend. Volume spikes during sharp moves down, showing strong selling pressure, while pullbacks occur on lower volume, reflecting weak buyer interest. As the trend progresses, volume begins to dry up even as price keeps falling, suggesting that the aggressive selling may be losing momentum. This slowdown in volume could signal the end of the markdown phase, and the early signs of a new accumulation phase. Market phases exist on every time frame, from micro to macro. A micro markdown on a 15-minute chart can be part of a macro accumulation phase on a higher time frame. That's why it's essential to ask, what phase am I in on the macro time frame? Aligning your trades across micro and macro phases helps you avoid false signals and follow the true trend. As illustrated here, short-term moves can be misleading without considering the bigger macro context. Remember, trading against the macro trend often leads to losses. Let's recap what we've learned about market phases. Each phase, accumulation, markup, distribution, markdown, has unique psychology, structure, and volume clues. Accumulation shows fear and low volume. Markup brings bullish structure and rising volume. Distribution shows fading volume and trap patterns, while markdown brings panic and high volume breakdowns. Always read the phase, trust the volume, and align your strategy with the bigger picture. Congratulations, you leveled up. Now you know the secret blueprint behind every market move. You understand the 4 key phases and the psychology driving them. This knowledge puts you steps ahead of most traders. Now it's time to put this knowledge into action and master the markets. Next up, we will be decoding the market's most honest signal, volume. You've seen how price moves, now it's time to learn why it moves. We'll break down volume like never before, with real setups, real behavior, and real clarity. Once you see volume the right way, you'll never look at a chart the same again. Get ready, you're one insight away from trading with real confidence.